when they're building millions of dollars in assets and they've had them for 15 to 20 years, they need to do something. And there's not many options and there's not much flexibility there for the clients. So these could be used to complement each other, right? You need some type of trust to mitigate some of the tax risk there.
So what would the ability to have some liquidity and some diversification and perhaps even invest into and go into financing mean for those that are selling huge assets, right? And to be able to convert that into, let's say, a premium financed product to unlock some of the benefits there?
Yeah, so a lot of the clients that we're working with, and I'm going to get to your question in a second, but when they're buying traditional insurance, it really doesn't make sense for the business owners and real estate developers that we're working with. Because when you're talking about the returns they're getting on their own deals, like let's say they buy like a real estate building, their caps that they're earning is like 10% plus. So when you look at a regular life insurance policy and it's earning 5%, that's not sexy to them. So they're saying I can insure myself and just keep my money in my own business rather than earning 5% in an insurance policy. So we actually have a big bank that'll come in and finance these insurance policies for them, where they put up like 10% to 20% of the total premiums going into the policy. And our story looks like this is why don't you keep your money in your own business? It's called retained capital. Retain your capital in your own business, have the bank finance your life insurance policy inside an irrevocable trust, have it, and the returns are looking like 10 to 15% tax free. So 40% taxable, it's like almost 20%. So it's the same types of returns you're looking at there, and the DSTs could be used to complement that because a lot of our real estate developers are getting out of these properties that are highly appreciated. So going back to what you said is when they're building millions of dollars in assets and they've had them for 15 to 20 years, they need to do something. And there's not many options and there's not much flexibility there for the clients. So these could be used to complement each other, right? You need some type of trust to mitigate some of the tax risk there. And at the end of the day, if they're worth 5 or 10 million plus, they need the insurance and they would like to retain all their capital in their business. So we say we're mitigating all those risks. We're saying, no, maybe not all of them, but for how we structure premium financing, we do like a 5 year loan rate where we lock it in for 5 years. And then after year 10, we could lock it in at like 5% or 5.5% guaranteed, depending on the company. So these are definitely good complements based on what we're talking about. And we come across clients every single day that could utilize what you're doing there.
Absolutely.
So I hope that answers your question.
It does. That was great. And by the way, Jacob Brigati, you can go to ufc.bz, ufc.bz. And so I want to kind of continue on this topic here, right? Of what the deferred sales trust can do for clients with flexibility, but also solving some of the root causes. One of the root causes and challenges with tax is what's called the death tax that the 1031 exchange does not solve for. And that on a stepped up basis, the capital gains tax steps up to the basis of at the time of death. So the heirs get a higher basis, which means they have either little or no capital gains tax at the time of if they were to sell. However, they still have a debt tax, right? And that debt tax is 40% of anything it's still inside of the taxable estate. And so there's basically two options. You can have a stepped up basis or you can have it outside your taxable estate, but you can't have both. Now, a lot of people buy life insurance to offset that debt tax, even though they have a stepped up basis, right? And that's part of the concepts of that. What we like to do is to eliminate that estate tax at the very ground level, right? Tear that root out now. And by doing that, not only do you eliminate the estate tax, but you can also get the life insurance policy. And that life insurance policy is no longer just offsetting the debt tax. It's just a windfall for the family, right? And so it's practicing just, great, like Rockefeller type of strategy, right? Where they're looking at and building life insurance policies based upon just wealth creation versus not just offset the tax, right? And so that's the beauty of the DST, that we are going to solve those challenges with the root cause, but also give you the ability to create more wealth. Any thoughts on that, Jacob?
No, I mean, I agree with that. I was actually going to touch on the Rockefeller strategy because we look at two different families that were both billionaires and multi-billionaires um, back a few hundred years ago, the Rockefellers and the Vanderbilts. And I mean, you know who the youngest Vanderbilt is right now? Or do you know it's actually Anderson Cooper on CNN. And he just inherited one of the family's like last of their money, and I don't know the exact amount, but it was like a few $1 million or $1 million, and they went from having hundreds of billions of dollars to a million. And there was a few factors that factored into that depreciating of net worth there, and it's the taxes, just like what you were saying. So if they use some of the tax advantaged solutions, like what you're talking about, that could have helped them out with offsetting the taxes, and it's basically that they're depleting their estate. I mean, the family members were buying all these big hotels and huge just hotels. They're building beautiful palaces and everything of that sort, rather than the Rockefellers. They were actually buying insurance on each of the kids. So the kids were taken out of the estate, but when they passed away, the insurance would actually um, go right back into the family trust. So it would replenish all the assets they took out. So I kind of like mentioning that all the time because when you're looking at the two different families, they took severely different paths. And hundreds of years later, I mean, you can see where the net worth is based on their planning they've done.